So here's the video that I've been not purposely putting off. It's just way the heck down on my list of priorities for videos as far as they go. Fannie, Freddie may need another bailout as Washington drags its feet on housing finance reform. And this is from Zero Hedge. Back in March of last year, the FHFA warned, and I know I did a video on this, that Fannie and Freddie may well go bankrupt, at which point taxpayers would once again be on the hook for subsidizing their own bad mortgage debt. And don't forget, as I mentioned in my other video, the head, I think it was a Freddie Mac, walked away with $100 million package. How do you have a failing company that without government assistance would go bankrupt tomorrow? How in the hell do you walk away with $100 million? Symptoms of a dying empire. The Roman Empire, it's falling. It has fallen. It's just now in the crumbling process. As you might recall, the Treasury changed the rules when it came to the GSEs a while back. Whereas previously the companies paid a dividend to the government on the preferred stock Washington owned. The feds decided instead to implement a quarterly profit sweep. As Bloomberg notes, the payments count as a return on the U.S. investment and not as repayment of the aid, leaving no existing mechanism for them to exit government control. That's irked equity investors who swear they're being illegally swindled by the government. No, the government wouldn't do that. Come on. It's America. I thought it was America. On Thursday, we learned that, again, this is Thursday a while ago, we learned that Fannie was set to pay the Treasury some $3 billion after reporting $2.5 billion in profit for quarter 4, 2015. The company, which has received more than $116 billion from the U.S. taxpayer since 2008, has paid the government $147.6 billion to date. What? Fannie Mae's 2015 net income was $11 billion, down from $14.2 billion in 2014. So as you're reading that, they're profitable. How they're going to need a bailout? What? Down from $14.2 billion in 2014. One reason for the decline was higher income in 2014 following settlement agreements on lawsuits related to private label mortgage-related securities, also probably known as fraud. Because of the arrangement, which prevents Fannie from holding onto its profits, the company's capital buffer could be completely wiped out by 2018. CEO Tim Mayopoulos warns. At that point, it would be unable to weather quarterly losses and would need to draw on Treasury funds to avoid being placed into receivership. So, ironically, the government's attempt to extract payments from the GSEs in perpetuity has left them without a capital cushion, which in turn will force them to, ask for another government bailout. This is reminiscent of the rather absurd scenario the companies were in before Washington transitioned to the profit sweep model. Previously, when Fannie and Freddie owed the Treasury a dividend on the government's preferred shares but didn't make enough money to cover it, the Treasury would loan the GSEs the money they needed to make the payment. Obviously, that's completely absurd, but as you can see from the above, the alternative, forcing taxpayers to bail the companies out again because the government commandeers the entirety of the company's profits, is equally ridiculous. The most serious task, and the one that has the most potential for escalating in the future, is the enterprise's lack of capital, Fannie's top regulator and FHFA director Mel Watt said. As Financial Times recounts, Fannie CEO Tim Mayopoulos said a range of options for solving the capital problem were available, such as allowing Fannie Mae to retain earnings, changing the terms on what gets Treasury support via preferred stock purchases, and taking it out of conservatorship so it could be recapitalized in another way. Of course, all of that is politically sensitive. Taxpayers aren't exactly excited about seeing these bastions of cronyism and outright waste and corruption privatized again, and allowing them to hang on to a portion of their profits is the first step in that direction. Whatever the case, Americans should probably go ahead and come to terms with the fact that both Fannie and Freddie will be drawing from the Treasury over the next few years. Housing finance reform isn't exactly moving at a breakneck pace, and it's not at all clear that income guarantee fees can offset losses from the decline in the GSE's retained portfolios. As for what further bailouts would mean for the health of the U.S. housing market, we close with the following passages from Watt. Quote, future drawdowns would reduce the overall backing available to the enterprises, and a significant reduction could cause investors to view the backing as insufficient. It's unclear whether investors would draw that line, but certainly before these funds were drawn down in full. Investors' confidence is critical Investor confidence is critical if we are to have, as we do today, a well-functioning and highly liquid housing finance market that makes it possible for families to lock in interest rates, obtain 30-year fixed mortgages, and prepay a mortgage if they want to refinance or need to move. If investor confidence in enterprise securities went down and liquidity declined as a result, this could have real ramifications on the availability and cost of credit to borrowers. So, there you have it. Once again, Fannie and Freddie Mae are in deep trouble. The first time from the old bank's own doings in the financial system. And now, if they had the system they had before, they would actually be okay. But now that Uncle Sam's gotten involved, they can't hang on to any of their profits. It's essentially a welfare state. I am reliant on the government. I always will need the government now to keep me alive. And I hate to say it, but I think that's exactly what the government wanted all along. Take care.